So we saw the markets reacted to Jay Powell as he was talking, but do investors react? I mean, did it change your investment outlook, particularly when it comes to fixed income?
So a little bit. I mean, one of the things that is changing, we've lived in the world for the last 2 to 3 years, 4 years, 5 years actually, where the central banks were everything. It's every word, every piece of information that came from the central banks was everything that you had to focus on for investment, how much quantitative easing we're doing. That is changing. The world is moving more from monetary to fiscal policy. So while what he says is important, it's interesting, I think as Alex and you guys were alluding to, since he started talking, the equity market has gone down almost 3% on Tuesday after being up for a couple of days. So the markets are still tuned into it. I think he did a superb job, by the way. But I think the markets are tuned into it. He made a couple of comments of being more confident on growth, meaning you could move your dot maybe up another notch. At the end of the day, the dot used to be everything, and we don't think it's as important as it was.
So if it's shifting, if it's in the process of shifting from monetary to fiscal, he did address some of fiscal and saying we're not necessarily on a sustainable path. Does that mean that you're more interested in what's happening, for example, with Treasury auctions and the extent of the deficit spending right now than even monetary policy?
100%. When you think about the amount of fiscal that's coming in today, it is extraordinary. From the corporate tax rate to the amount of spending, whether it's defense, non-defense, disaster relief, to the repatriation timing, the amount of stimulus that's coming in the system is extraordinary. And by the way, we're going to have to finance an extra $1 trillion a year to get there, which we can't, which quite frankly, I would argue in a lot of ways, it's hard to afford. I describe it a little bit like economy's been operating at a pretty good level, and now we're spiking the punch bowl. And so it's going to be a lot of fun. The growth is going to be higher, but then we got to pay for it. Inflation is going to accelerate, and then we're going to create a dynamic where we've got to pay for all this. That's why rates are going to move higher. I think they're going to pause a little bit here, but then they're going to move higher again the second half of the year.